everyone, welcome back to EduTap and welcome to the Phenonomics series. In this series, we are trying to simplify the topics and terminologies of economics and finance, as well as we are trying to upgrade the information regarding the topics of the economics and finance that you already have. So today there is a very interesting topic that I try to bring for you, and that is why RBI introduced the standing deposit facility. The RBI already have many policy tools, many policy rates to boost the growth of the country, to control the inflation in the country. That is, the tools are the repo rate, the reverse repo rate. So such kind of tools are used by the Reserve Bank of India to control the liquidity, to control the inflation in the country. So why this standing deposit facility was introduced, and what is the standing deposit facility? So all of this we are going to discuss in today's session, as well as we will discuss the difference between the reverse repo rate and the standing deposit facility. Both are taking the deposits, both are related to the deposits. So how these both are different, and when there was reverse repo rate present with the RBI, why the RBI introduced a new tool such as standing deposit facility. Okay, so all of this we are going to discuss in today's session, and this is very important from the exam point of view. You need to have the clarity of such kind of terms. They are directly related to the Reserve Bank of India. Okay, so now before starting with the session, please subscribe to our YouTube channel if you are new to the channel, and join our Telegram channel for the PDF of this session, and you can get the link of the Telegram channel in the description box below. So now starting with the reverse repo rate. See, the repo rate and the reverse repo rate has already been discussed in length in a previous session. I will provide you the link of that session in the description box below. Okay, so you can have the greater and in-depth understanding of the reverse repo rate of the repo rate in that session. I will provide you an overview so that you can understand the reverse repo rate, and you can differentiate the reverse repo rate with the SDF and have the better clarity about the SDF. Okay, so starting with the reverse repo rate. See what happens. Let's take example. Okay, you earn 30,000. Now you are spending 10,000 from this 30,000 only, and this 20,000 is left with you. You can either hold it in your hands and you will not earn extra money on this. You are just holding this money with yourself, or you are just keeping this money with yourself. Or you can deposit this money in the bank accounts and you can earn the interest on this money. Okay, by the end of the month, you are able to earn 500 rupees extra on this 20,000 rupees by depositing this money in the bank account. So what is happening here, that you are earning the money over the money you already had. So what is the better option? Holding this 20,000 rupees, keeping this 20,000 rupees with yourself and earning nothing over it, or depositing it in the bank accounts and earning some interest over it. So of course, this is a better option because you have the money and you are generating more money from the already money you had. So similarly, the commercial banks also have the same option. Okay, they have the surplus cash with themselves. They have a lot of money that is lying idle with themselves in their vaults. So what the commercial banks will want to do, they have money in crores, okay, in lakhs, in crores. So they will rather keeping the money idle, they will want to deposit the money with the Reserve Bank of India. Now the Reserve Bank of India is at the apex, it is at the top of the banking institutions, it is at the top of the monetary system of the whole country. So the commercial banks have the option to deposit their money with the Reserve Bank of India. So the commercial banks can deposit their surplus cash with the Reserve Bank of India, and the Reserve Bank of India, when the Reserve Bank of India will get the deposit, it will give the government securities to the commercial bank. Okay, the government securities are given of the similar amount, we can say, or it is of the near amount. Okay, commercial bank has done the deposit with the central bank, as well as this government securities is for the trust of the banks, we can say. Okay, so whenever the commercial banks deposits the money with the central bank give the government securities to the commercial bank of the similar value. Now when the commercial bank wants the deposit back, now the commercial bank is going back to the Reserve Bank of India, and the commercial bank wants the deposits back. So the commercial bank has to return the government securities that it had got from the central bank. So the commercial bank is returning the government securities to the central bank. The central bank will see that government securities, and the central bank will return the money, the amount that was deposited, the the amount that was deposited will be returned back, plus the interest will also be given. And this is reverse repo rate, that is the interest that is given on the deposits of the commercial banks with the central banks, against which deposits the commercial banks has got the government securities. So this is the whole process of the reverse repo rate or the reverse repo instrument. So here the commercial banks give the deposits to the central bank and take the government securities. Then the commercial banks has to return the government securities to take back their deposits as well as the interest also. Okay, so at last the commercial banks are getting the deposits back as well as they are getting the interest over their deposits. So this is the whole process of reverse repo rate. Now the reverse repo rate is a process through which the RBI tries to suck out the liquidity from the economic system. How? So in this way, let me clarify it so that you can better understand. Let's say this is a particular commercial bank that is giving 100 crores, that is depositing 100 crores with the central bank. So the central bank has given a government security, a government bond of the near amount to the commercial bank. Now in this way, what the central bank has done, the central bank has locked the money of this commercial bank with itself. So the central bank now has 100 crores and this 100 crores is taken away from the commercial bank. Now the commercial bank cannot use this money to give out the loans. So in this way, the money is locked with the vault of the RBI. The RBI has locked the money with itself and the RBI has sucked out the liquidity, that is, this commercial bank cannot use this money to create the credit, to create the loans. Because if the loans would have gone out in the system, what would have happened? The demand would have created. I am taking loan for houses, you are taking loan for car, another person is taking loan for factory, another person is taking loan for creating some infrastructure. So in this way, the loans are taken to create demand. The loans are taken to create demand, and when demand increases, what happens? When the demand increases very fast, the prices increases very fast, that is, inflation comes in the economy. Okay, so when the prices increases very fast, the demand increases, the prices increases very fast. So in this way, if the RBI wants to control the inflation, the RBI uses the reverse repo rate to suck out the liquidity from the commercial banks. Okay, in this way, the Reserve Bank of India is sucking out the liquidity from the commercial banks by taking the surplus cash, by taking the cash from the commercial banks. And when the inflation is very high, the central bank increases the interest, increases the reverse repo rate or the interest that the central bank will give to the commercial bank, so that more and more money comes to the central bank. Okay, more and more money is deposited by the commercial banks to the central bank, and so this inflation can reduce, because when the loans reduces, the demand will reduce. When the demand reduces, the prices will start reducing. So in this way, the central bank can suck out the liquidity from the commercial banks by increasing the reverse repo rate. Okay, so when the reverse repo rate increases, that means the interest is increasing. We will be, or the banks will be more motivated to deposit their money with the central bank. So this is the process of reverse repo rate. When the inflation was there, see what happened. Then from January 2022, we have seen the inflation. The RBI wants the inflation to be 2 to 6%, to be around 2 to 6%. That is, this is the lower limit of the inflation. The inflation should not go beneath 2%, below 2%, and the inflation should not increase above 6%. So this is the idea of the Monetary Policy Committee of our country. This is the idea of the Reserve Bank of India of our country. Inflation should not go below 2%. The inflation should not go above 6%. So what happens that from January 2022, continuously for 8 months, we have seen that the inflation is above 6%. The inflation is continuously above 6%. It was 6.01% in January 2022. It increased to 6.07% in Feb 2022. Then it increased to 6.77%, 6.7%. Then it increased to 7.79% in the next months. So you can understand that the inflation was so high that the RBI had to control it. So now you will say, just use the reverse repo rate and take the money from the central banks, from the commercial banks, and the RBI will be taking the money from the commercial banks, and the RBI will be giving the government securities. In this way, the commercial banks will not be able to create much loans, and the demand will reduce, and the prices will reduce, the inflation should reduce. So this is the easy process, right? The RBI already have the tool to control the inflation, but now the problems comes of the government securities. The RBI do not have such unlimited government securities that it can just give to the commercial banks and it can take the money from the commercial banks, it can take the deposits from the commercial banks. So now come the point that the RBI do not have unlimited government securities. So this government securities has to be removed if the RBI wants to take more and more money from the commercial banks. Okay, so what happens? So what was the problem in the reverse repo rate? Now I hope you have understood the problem in the reverse repo rate. In the reverse repo rate, under the reverse repo instrument, what was happening? The commercial banks were giving the money. They were depositing their money with the Central Bank of India or the Reserve Bank of India. They were depositing their money with the Reserve Bank of India. Reserve Bank of India had to give government securities of the same value or near value. The RBI do not have the unlimited government securities, so the RBI thought that why not create such an instrument where we will take the money, we will take the deposits from the commercial banks, but we will not give the government securities. So the RBI will not give the government securities, it will only take the deposits from the commercial banks, and this is known as standing deposit facility. That is, the commercial banks will give the deposits to the Reserve Bank of India, but the Reserve Bank of India do not have to give the government securities to the commercial bank. Now, what will you prefer? Will you prefer reverse repo rate or the standing deposit facility? I would rather have this because the government securities are there now. So I have the security in a way that I have this government securities with me. So why will I take this? I will take this if there is more interest that I am getting here. So what happened that the reverse repo rate was 3.35% here, and the RBI introduced the SDF at 3.75%. Now the Reserve Bank of India can take the money from the commercial banks at higher interest rate. So it is a win-win situation. So what happens? That the RBI do not have to give the government securities because the government securities are not unlimited. Okay, so the RBI will not be giving the government securities, and RBI can take as much deposits as it can take. So RBI will be taking huge amounts of deposits from the commercial banks without giving the government securities. So the RBI is benefiting because the RBI do not have to give the government securities by taking the deposits after taking the deposits. So the RBI is winning because it do not have to give the government securities. Now here the banks are also winning because they are getting higher interest over their deposits. So you can understand that the Reserve Bank of India is winning because it do not have to give the government securities because the government securities are not unlimited, and the RBI wants to have more and more deposits from the commercial banks to control the loans, to control the liquidity in the economy, to suck out the liquidity in the economy. So the reverse repo rate and the SDF both are sucking out the liquidity from the economy by taking the deposits from the commercial banks. But the SDF is sucking out the liquidity without providing the government securities to the commercial banks. So under the SDF, the RBI can continuously suck out the liquidity from the economy without giving the government securities. Just it has to give a little higher interest rate. So this was the first reason that why SDF was introduced, and SDF allows the banks to park their excess funds, surplus funds at a higher rate than the reverse repo rate, but without taking any collateral from the RBI. So the commercial banks will not get the collateral, but they will get the higher interest rate. And already they trust the Reserve Bank of India so much that they do not at least need this collateral. Government securities is just a collateral to build the trust, but it is not needed when we are talking about the Reserve Bank of India, such a trustworthy organization in our country. So the banks can easily deposit without taking the government securities at a higher interest rate. So this is the SDF. Now there was one more reason to bring the SDF to bring the symmetry in the LF corridor. So see, the LAF, that is the liquidity adjustment facility corridor. In this, there are the three rates: reverse repo rate and the marginal standing facility. Reverse repo rate means that the commercial banks are depositing their money. Commercial banks are depositing their money with the Reserve Bank of India. At that time in April 2022, the reverse repo rate was 3.35%. The repo rate means that the commercial banks are taking the loan from the RBI. Are taking the loans from the RBI, and of course the RBI will want to have more interest on the loan and it will give less interest on deposit. So the repo rate was 4%. Okay, when a bank gives you the loan is at a higher rate and the deposits are at a lower rate. So when the RBI takes the deposit, it is at a lower rate than the repo rate, that is at the rate at which the loan is given by the RBI to the commercial bank. Now the MSF means marginal standing facility. This is a rate at which the commercial banks are taking the loans from the RBI at a very, like when there is a huge emergency situation for the commercial bank, for the banks, then the banks can take the loan from the Reserve Bank of India at the MSF rate, that is at a higher rate. So in a very emergency situation, the banks will be taking the loan from the RBI at this higher rate. So now here you can see that there is no symmetry. Here the difference between the reverse repo rate and repo rate is 0.65 percentage, and the difference between the repo rate and MSF is 0.25%. So you can understand that there is no symmetry, that if the repo rate moves, we do not know that the reverse repo rate will move or not. And the MSF and repo rate are connected because the MSF is always greater than repo rate by 0.25%. This, they already have a defined relation, that the repo rate and MSF are related because the MSF is greater than repo rate by 0.25%. But the relation between the reverse repo rate and the repo rate is not defined. So there is no symmetry, we can say, because there is differences in this LAF corridor, in this liquidity adjustment facility corridor. So now it is called liquidity adjustment because through the reverse repo rate, the liquidity is sucked out, the deposits are taken, so the money is being taken by the RBI. Through this, the money is being given by the RBI. The RBI is giving the loans to the commercial bank. It is giving more money to the commercial bank so that the commercial bank can give more money to the people as loans. So this is increasing the liquidity, this is decreasing the liquidity, and that's why we call it LAF, means liquidity adjusting facility, liquidity adjustment facility. So this has no symmetry. We do not know that if the repo rate is increasing, how the reverse repo rate will change. At least they have the relation between the repo rate and the MSF. That's why the SDF was introduced. So here we are introducing the SDF. Now, which is the ceiling of this LAF? The MSF, because the MSF will be the highest. The loan that is given in the emergency situation, it is the ceiling of the LAF corridor. Now the floor of the LAF corridor, before it was reverse repo rate, which has been cancelled, and now the floor of the LAF corridor is SDF. The floor of the LAF corridor is standing deposit facility. Through this also the liquidity is being sucked out of the system. Okay, but under the SDF, what is happening? The commercial banks are giving the deposits to the RBI. So the same system is there, just no government securities are involved. Okay, so here the SDF is doing the same work as the reverse repo rate without involving the government securities. As well as there is symmetry that has been created through the SDF because it has been defined that the RBI has defined it that the SDF will be lesser than repo rate by 0.25%. So if the repo rate is 4%, the SDF will be 3.75%. So here you have seen the symmetry. The difference between the SDF and repo rate is 0.25%. The difference between the repo rate and MSF is 0.25%. The SDF is lesser than the repo rate by 0.25%. The MSF is greater than repo rate by 0.25%. If the Monetary Policy Committee changes the repo rate, the whole of the corridor will change together. So this was the motive of the Reserve Bank of India to bring the SDF also. This is the second motive, so that the country can know that if the repo rate is being changed, the other rates will also change in a symmetry. Together they will change together. Okay. So currently, what is the rate of the what is the repo rate currently? If you know, currently the repo rate is 5.40%. So what will be the SDF? The SDF will be 5.15% because the SDF is lower than the repo rate by 0.25%. The MSF will be 5.65% because the MSF is greater than the repo rate by 0.25%. So if repo rate is changed, the other rates will also change. So this is the symmetry that has been brought. I hope you have understood the SDF. You have understood that what is the role of the SDF in the LAF. It is the floor rate of the LAF. Okay. If you have any query, you can mail us here or you can contact us through this number. This is the question that I hope you will be able to easily answer. This is the second question. So thank you very much everyone.